We have industry which has stamina, which thinks long term. We have politicians who don't always do so. They often think about the next election rather than 20 years down the line, and it's often difficult for them to make major investment decisions when the population might care more about school funding, hospital funding, and so on. Then you have the private financial world that tries to make sense of all this by creating these scenario-based models. And then you have the general population who's perhaps concerned about these models. We've seen it before with the financial crisis. We've seen how the banks create financial structures that on the surface seem risk-free, AAA rated, and then all of a sudden it blows up. So along those lines, I'd like to explore the systemic risk, the risks to society, not just risks to investors and investors losing the money, but also systemic risk. And perhaps Tina Saltvedt, Chief Analyst at Nordea, is that something that you consider, the systemic risk of investment in this change?
Absolutely. I think we as a financial sector, we learned a lesson after the financial crisis, and that was that we didn't price risk correctly. What we have seen now is that the cost connected to the climate changes are starting to influence investments, but it's starting to influence the economy as well. So what we're trying to do now is starting to implement climate risk or pricing climate risk correctly, because that's very important to move the money in the right direction to give the best income for the investors and, of course, the companies.
And pricing or putting a value on the potential rewards as well, plus a timeline, because timeline is important.
Yes, and that is the challenge we're working on now, because usually the financial market is very short term. And that is not what you really want when you're talking about climate changes, sustainability. Sustainability and pricing sustainability need to be long term. So we need to work with our business models to be much more long term. We usually think about quarterly reports, quarterly results. That is something we can't do in the future. We need to look further on in the horizon and start to price and think much more long term. 3, 5, 7 years, because that's where we're really going to see the big risk or challenges from, and also, of course, the opportunities with these changes we've seen.
So we need to switch to long-term thinking, away from short-termism. The financial sector has always been accused of being too short-termist. We also have an industrialist here with us, Ståle Gjersvold, Chief Executive of Trønder Energi, the local energy company. When you speak to investors, what reasons do they give you for being skeptical to the extent they are?
When we talk to our investors, it's mainly about having a clear direction where we are going. And the challenge for the moment is that, as some of the speakers have said, that you are not able to see long term when it comes to what's happening with the prices. And we have done some scenarios about what's going to happen around the price. And actually, and this is, we are using system dynamics, which means we're looking more about this as a system, not as some deterministic things. And what we see is that the main risk is actually the regulations. How do the governments change different parameters? And that's quite interesting. So for the moment, that is a key thing when it comes to, it's not the technology, it's not the market, it's more what's going to happen. And now I'm talking about Norway, for sure. I'm talking about Norway as a nation. I'm not talking about globally. But this is quite interesting.
Idar, in the world of finance, it must frustrate you, this exact thing, that governments are often fickle. In my career as a journalist, I recall perhaps 5 brief periods where the green story has been the story. And during those times, the governments might introduce a bit of legislation, maybe take some initiatives, but then if the economy has a slight dip, other matters become more important. You guys, meanwhile, you hate uncertainty. How do you deal with fickle governments?
I mean, let me put it the following way. In the public discussion, we have a tendency to focus on our disagreements between the different parties, between the different stakeholders. The important thing to us as investors and banks financing this is to try to identify the areas where we do agree. Because when we do agree, cross-party, cross-sector, that tends to lead to stability when it comes to regulation. So I had the pleasure of working on a project called Green Competitiveness a couple of years ago, and one of the key things we put forward was a list of proposed 10 policy principles that should form the basis for agreement cross-party, cross-sector, so that you could give some sort of signals of stability through what you might call the policy cycle. Because regulatory uncertainty is a fundamental risk, and it prevents investors from taking the long-term perspective. On the other side, if we are able to set down some of these principles, it will have an immense impact. And just bear in mind, the principle of polluter pays. That is a principle that stuck in the Norwegian debate. It was first stated in a policy document in 1992, and it still lives. If we are able to create 3, 4, 5 policy, long-term policy statements like that, that will increase predictability, reduce risk, and release investments.
This might be heartening to see that the finance industry is also taking a role in what's often called lobbying, influencing governments, making the governments take the right decisions. Of course, you can all do this, and I'm sure many of you do. Let's bring in some of our experts here who might have some questions. Sergey from MIT. Sergey Paltsev from MIT, you have views on this?
Yeah.
Questions to the panel?
I have a question to Michael. So thank you for a wonderful presentation. It's a very impressive job at doing all this, and I think it's a lot of users of what you are producing. I would like to explore certain thing in a little bit more detail. So you said that you are looking at the 2-degree scenarios from IEA, or at least start with that. As we have heard today and in our work, well, we all know that there are many scenarios which are going to lead you to 2-degree. And with very reasonable assumption, I can create a scenario where there is no role for nuclear, or there is no role for CCS, or even renewables are not doing that great. So how do you deal with that? How do you advise, oh, this asset is not really a good asset? How do you provide that level of uncertainty? How do you put that into your scenarios? Because, well, even coal might be not that bad if it's coal with CCS.
Yeah, that's a very good question. And there is a limited number of scenarios that are available that we can actually apply to financial investments, because the way that the models have been generated in the past is that they're for the scientific community and not for the investment community. And so although we have all these thousands of models from the integrated assessment modeling community that are great and that delineates the carbon budgets and whatnot, we only have a handful of organizations such as the IEA that then try to translate these into economic indicators that can be used for to inform investment. So having said that, we do have one hand tied behind our back there, and we can only use scenarios that that have already been built. And there's a need basically for more, and a need for the IAMC community to produce results that are more relevant for the financial community, so we can use that great work that they're doing and enable it to finance the transition.
Very good point. Sonia, I have a question that's, as a storyteller, I'm very interested in. We are talking here mainly about investment in infrastructure, in storage, in grid, in technologies. What about investment in changing people's behavior, changing the way people think about the transition, but also, and perhaps for all of you, what about broader investment in urban architecture to make people walk and cycle more, all that sort of stuff? Or is it, I mean, the finance sector should obviously not just be limited to invest in the technologies and the infrastructure, right? So perhaps you, Sonia, on attitudes, but others in the finance sector.
I'll try. I think from my company, Statoil, it makes sense to invest in energy infrastructure because that's where our competence lies. So it's kind of not going beyond where we can actually contribute. I think that's our point of view. So
you also need the support from the population, right?
Of course, but it's, you know, for us it's important to see that this is it's an ecosystem of various things that you can do. And digitalization, of course, plays a huge role in the future energy systems, and from that you can derive a lot of benefits for us as citizens to drive the direction we want for ourselves. And there I take an ownership as a mother of three and, you know, everything that comes for the future. But, you know, from an investment point of view, I don't see that Statoil is the right company to go into your home and start making changes to how you behave. But maybe someone else can. On the policy side, I guess it's to do with, you know, what we want as a country and what direction we want to go for ourselves.
And Ida, you had a point here.
You know, the finance sector, we are not specialists in any certain area, but we do invest in the transport system, in ports, in airports, in railways, in motorways. We do invest in real estate, and that's the biggest portfolio of the Norwegian banks is, of course, real estate, and we do invest in the energy sector. What we need to understand and build our experience on is to try to understand the interrelationships between these different processes, and that is an important kind of knowledge that is built in the industry. And one piece of information which is interesting is that we have started to track what is the price development of climate certified real estate. So you see that climate certified real estate tends to have a higher secondary price than not climate certified infrastructure. If that is consistent, well, that is a pricing signal into the credit process, because then you reduce risk by credit certification on real estate, and the credit certification is very much dependent on the energy system. So by building that kind of knowledge, you increase understanding and reduce risk.
So also part of the solution, but of course all these areas compete for the same pot of money. Knut Anton Mork, do you have a question for our panelists, please?
Yes, a question first to Tina about short-termism. That has been much maligned, of course, and yet when you talk to finance people, they tell you that the short term is important for the long term. And I think there's a very important grain of truth in that, namely that the short-term numbers you get, the quarterly results, the daily stock prices, etc., they tell you what these assets are worth. And I worry that if we all start to preach long-termism only, that will advocate investment in things that we don't really know what is worth. And that is a risk that needs to be handled somehow. And this leads me to my question to Idar, which is of the same nature, namely to invest more in infrastructure. It needs to be stock listed. Because if it's not listed, we don't know what it's worth. And I really worry about the portfolio managers who can then tell their bosses and their ultimate investors that, oh, this is going wonderfully, I know what I'm doing, just wait 10 or 20 years down the road, this is going to pay off. How are we going to manage those things?
Perhaps a powerful and important statement, not necessarily something you want to answer. I mean, have a go.
Do you want me to start? Yeah. Of course, we should focus on some projects are short term, some are long term, and yes, of course, stock prices give us a kind of indication of how the company is doing today. But we haven't been good enough so far to take in the risk, which the sustainability thoughts are, and that's the long-term risk. Because today we're pricing the short-term risk, but we don't consider enough the changes. For example, climate changes are long-term risks as well. And we, in our business models today, we don't price that properly, in my opinion. So, of course, we need both short-term and long-term, but today we're focusing too much on short-term, and that's worrying me. We don't take into account the long-term enough.
Should I continue, because I got a question too, and it's really two questions, Knut Anton. One is the balance between short-term and longer term, and I think it's fair to say that what we try to do is to understand the risk implications of elements that we do not take into account today, and that's not a new thing. We have done that for a number of years. We get new information, we try to put that into a system, into a structure, and we try to understand the implications and price the implications today. You know that some of the insurance products we price, they have a tail of 15, 20, 25 years. We need to price them today and then put a value on them. And yes, it is a price with significant uncertainty embedded in it, but we cannot avoid taking into account something that we know will have an impact, even if we are not 100% certain what that impact will be. So it is always that kind of balance, and I do not fear that the long term will take precedence over the short term in the financial markets. I really do think it's important to try to understand these long-term processes and try to price them into the markets today in a better way than we have done historically. So that's question number one. Question number two has to do with listing and listed and unlisted assets. That's a discussion. And it's not a right answer to it. It has to do with you as an investor. What kind of risk would you like to take? If you say as an investor that I put liquidity on top of my agenda, I only want liquid assets, I would like to terminate 100% of my portfolio tomorrow without affecting the market, stay in the listed market. But if you say that, well, some things are happening in emerging economies, some things are happening in new technologies. Some things are happening in the area of infrastructure. We both know that a large part of the infrastructure in the market today is not listed. I mean, people do not list their airports before they sell them. So if you would like to take a piece of that and take risk on that, well, take that risk. But it's an investment decision. And we shouldn't say what is right or not, but if you are prepared to take that investment risk, you should build a competence and reduce the risk by increasing your experience.
I think we can segue quite neatly onto a question from the audience here, where we have many brains, we have many scientists here, we have many people with good ideas. What about investment in ideas, in entrepreneurs, moving beyond the big institutions investing in the large corporations? Anyone here who's got a view or a question along those lines? Let's take another question. Maybe that was a bad question. Catch.
Nope.
You can throw it again if you like. Any?
Nobody wants, I can try.
You go for it.
Well, my name is Casper. I'm a student here at NTNU. Basically, I want to ask a little bit of a question about investing in renewable energy. Because when I talk to my parents usually, they are really skeptical because it's so long-term. They want to see the results right away. They want to see the money right away. But when I try to convince them, oh, it might be profitable, it might be something you should invest in, they're like, no way, because I don't see it right now. How can we make people with that skeptical mind more interested in the option because it will promote renewable energy investments?
Should Statoil give a go? No, I think by showcasing the good examples. You know, this, first of all, renewable energy is a part of Norway. It has been since 1904. So renewable as a concept is not a new thing, but it's new technologies. It's solar, it's wind, and it's other elements. And starting off, you had enthusiasts believing in this. So it was based on investment belief, not some sort of experience or documentation. But now, I mean, the showcases are numerous. So I think we should be even more focused on showcasing the good examples and through that create the necessary curiosity, wanting to learn more.
I also think that it's important to get better understanding of how the financial markets works. So explaining how these risks we're now going to price in, for example, how the long-termism in the way of thinking about sustainability and climate. Because today it's difficult for many people to understand that, you know, the risks of not doing anything today will have even a worse impact tomorrow. If we don't do anything today, we will have we'll be in even worse problems or troubles. So I think it's important to get a better understanding of, you know, how this will affect us. Maybe we should try to calculate, you know, the price of doing nothing, the relative price of climate changes, because that could highlight, you know, the importance of doing the right investments today. I think also it's we like to do as people will like to help out, and we're starting to see the climate changes and how it's affecting us. We are good at, here in Norway, you're splitting your garbage in different bags, for example. But I think it's important also to try to explain to people how important it is for them to place their money in the right direction, because that will have even more impact on you know, how to help out on the society and the climate risk. So putting your money in the right companies in a sustainable way will have a big impact on actually moving, you know, the society to a greener direction. And getting a better understanding of this requires information. So information, I think, is essential to get people to invest in these technologies. And of course, it helps with showcases, where you can actually see that these policies we have, for example, subsidizing wind and solar power is now starting to work. For example, here in this country, how the where they helped with better agreements for electric cars, for example, have helped you know, the growth of the electric car markets. So I think giving them information will help a lot.
And tell them to invest for their grandchildren, not just for themselves. We have Daniel Mutman here from Open Grid Europe. Do you have a question for the panel, please?
Working? Yes, okay. We have heard this morning that in order to achieve the climate targets, infrastructure is very important. And since this is an energy transition conference, I think we're all interested to explore how can things get better and actually get closer to where we want to get. Because of the low interest that we have had in the market for quite some years now, a lot of financial institutional investors have bought grids, power grids, gas grids, and are heavily invested in those, which means they took the regulatory risk. They basically said, as you mentioned earlier, they made an investment decision. They said, I'm going to live with this percentages, and I think this is a good investment for a longer term. They're not financial investors. They're for like short term, they're pension funds who have maybe a 10, 15-year time horizon. So here comes the challenge. We, in our company, as I am a head of strategy, we did a strategy review process with top management, and I convinced everybody that at the end of the day, what we believe in is right doesn't depend on who is our owner. It depends on what as people running a company and seeing a market, what we think is right in order to make good decisions for the future. Where the owner comes into play is that we need to explain it to the owner as to why we should do this. And here is, of course, again, as in many of these cases, the chicken and egg problem. We, as grid operator, know that if we want to get into the world that a lot of studies and industry says we should get to, we need to invest. We need to invest in, combining gas and power grids, having power-to-gas facilities, having whatever. There's many things you can think: hydrogen injection, hydrogen networks, and so on. Today, there's no regulatory framework for this. So you might start with some good example pilot projects, but even those you have to sell to your shareholders and say, I'm going to do this because I think it'll, in the long run, create options that the infrastructure can be used for something else in the future, and so on. But it's very difficult, and I have not yet had the privilege, because I'm only in this job for half a year, to meet the shareholders, but I will pretty soon. But the key challenge is that what I've heard from my colleagues is, of course, at the end of the day, they listen, they engage in a discussion, but it's down to the numbers. And how can you show somebody the return of an investment in a hydrogen project or a power-to-gas plant, which today is not economical? So I would like any reflections you may have up there as to what kind of debate needs to take place there, or is the debate a very short one, because unless the regulatory regime changes, we can't do these things.
Can I start? Because I think, your point about having innovation basically through even when you don't see what it's going to innovate into is important. And for any company, I think it's very important, because otherwise you'll just, you'll develop what you had, but you will never be part of the future. But one of the examples I thought was interesting when you mentioned grid, I just read the other day that there was a company in Italy where they had to curtail quite a lot of wind because of lack of grids. And what they've done is they invested in batteries, because that's what everyone is talking about. How can you actually adopt the storage so that you will be able to store the excess power, and hence you wouldn't have to waste it. But what they also did was to add sensors to the high voltage transmission lines. And what they saw was, with a very small investment on the sensors, they could actually use the grid much more. So they had much better capacity than what the battery actually gave. So the battery was a big, expensive investment and gave very little loss, or less curtailment, but the sensors gave a big impact. So I think the innovation shows that you don't necessarily have to invest big, but you have to invest right. But you have to keep looking for them. So I think that's the point where we're seeing. We still have R&D and startup we've had for many years, and we do look at other things than just the ones that are in part of our core.
And briefly, Jay, as well, you talk about these models that will help companies predict these things better.
Yeah, the role of the scenarios and the models isn't to make the risk go away, but actually make it more visible, so that what was flying under the radar, and the whole motivation really comes out of, you had risk not being recognized leading up to the 2008 recession. And so coming out of that, the G20 was asking themselves, like, well, what else do we need to be thinking about making clearer and more transparent? And hence, when you look at the scenarios, the question of the scenarios, I think, boils down to, how do you create a set of scenarios, this notion of an anchor scenario, where you can go and there's a place where you can You can have something that you know others are utilizing. It's transparent. You know how it was created. Potentially, you can get to the tools that were used to create the scenario so that you could explore alternative evolutions and see where, even more in more detail, where this risk is arising, so that you can actually have a better and clearer understanding of the risk, so that when you can take that to the markets and to your own strategic planning, so that you can begin to take that on board. Not that it is making the risk go away, it's actually making the risk more visible.
And of course, your investment will also affect which scenario becomes most successful, at least if you get others with you, right? Idar, very briefly on the same point.
If you are spending your own money, you need to convince yourself. If you are spending other people's money, you need to convince them. And it is important to understand that the investment market is a relatively sophisticated one. So you are not presenting to one uniform group. So it might be the case that your existing owners hate your idea, but that if you present it well, you will be able to attract new investors with the necessary knowledge, with the necessary time horizon. So spend time not only developing your own idea, but understanding the market, the financial market you are presenting your idea to. And then you will find the right investors who will support your idea and be a good owner in the longer term.
Very good. Anders Strömman, you have a question.
Yes, thanks.
Anders Strömman from NTNU.
So, Michael, I got a question for you. So you saw the early panelists here talking about scenarios, and we saw how the pledges from the countries, and we should say the nation states have had a lot of good information over many years about the direction of where the emissions are going and where they need to go to reach a 2-degree target, and they've not been able to make pledges that are steering us towards that. And we saw quite a bit of pessimism in an earlier panel. So I was wondering if you could provide us with a bit of optimism in terms of, are you seeing investors, and so I wanted to tap into a bit on your insights in communicating your analysis to investors. And so I think it's very positive that you're actually doing that. I was very impressed by the work you presented. And I think it's very good that this is done, but do they actually act upon this? And do they feel are they acting quicker than nation states? So basically, the absorption of the knowledge and the impact of your analysis. Can you give us some insights on that?
Yeah, sure. So first, to start, as I mentioned before, we've engaged bilaterally around 200 institutional investors. But as this is still in its dormancy, these institutional investors are largely the ones that are trying to sell an SRI, so a socially responsible investing products, and so it's not necessarily in all cases you're being mainstream institutional investors. So a lot of the more personal feedback that we've had and engagement is obviously with the SRI investors. And in this case, yes, so we've been doing it over the course of the last 2 years to be exact, and we have people coming back to us, investors now, coming back to us with new portfolios and saying, hey, how are we performing now? We got the results last year. We're completely misaligned in this technology, that technology. We've changed our portfolio weightings. What does it look like now? We're actively trying to adjust it. So I think that's optimistic. You do have players out there that are using the tools that are available to try to align their investments with climate change and doing the best they can. And so hopefully now, if we producing a service where anyone can do it online for free, that this is done more regularly and they do it actively and play a more active role in managing the transition risk.
Fascinating subjects. I think we could go on for some time, but we are, in fact, running out of time for this session. I think we can take 2 more questions. Anyone from the audience here? We have a hand. Tell us who you are, please. And
you ask, and the new student. It's quite interesting.
Stand up, please.
Okay, I'll try. Ask, and the new student. It's quite interesting that you both have Tina Saltvedt and Statoil here, because I want to ask you about stranded assets and what I'd like to call destructive investing, because the Norwegian government were investing heavily in the Barents Sea, the Barents Ocean, looking for oil and gas. So basically we're not even investing in renewable energy. We are actually investing in fossil industry, and we're investing heavily. And at the same time, Statoil, you're investing in offshore wind, but still in 2050, you say that your portfolio will still be like 90% oil and gas. So, okay, maybe we can earn some money in the future, but what's good with all this money if we live in a world that's not livable anymore? So, is there any hypocrisy there, or is it just cold calculation?
Yeah.
Anyone? Want me to start? Yeah, I can start with you first. What we've shown is that our ambition is by 2030 that we will have 15 to 20% of our investments will actually be within the renewables. So that was what Irene mentioned earlier on this morning. So that's our expectation. That said, it depends on projects. So I think what we will see is that if we find more profitable projects within renewables, we will invest more. This is a competition internally as well, so it's about finding those right assets that we can develop. So again, it's back to looking at what we can develop within oil and gas. And it's oil and gas demand doesn't go away even if we stop producing. So that's also another thing that we need to be keeping in the back of our mind, and at least that's part of the discussion. Because what we're trying to do is to develop those assets in a very sustainable way. And if you take away the production that we do and you kind of pop up production elsewhere with much higher carbon footprint, what have you resolved? So of course we need to take down demand. That's part of the whole equation. And it needs to go hand in hand with supply. So it's about doing both at the same time. So how do we change our behavior, basically, so that we reduce our demand? At the same time, what we need to produce it sustainably. So what we're doing is participating in how to decarbonize, and we've showed already how we can do that with natural gas. We can take out CO2. If you're willing to pay, you can get clean hydrogen instead. And that is how we're trying to develop a sustainable, low-carbon future. So it's not that we're trying to move away from it. We're actually very much bullish into investing a lot of our internal research and our internal competence in finding solutions for the low-carbon future. So I'm proud to be part of the company.
I think one of the most important decisions or political decisions which was made in Norway last year when it comes to climate was that they decided to set down a group which is going to calculate the climate risk of Norway. And that will be very interesting what this group concludes with, because they're going to look at the oil fund, they're going to look at Norway's unused potentials, and they're going to look at our investment in Statoil, amongst others. And I think this will be very interesting to see what kind of calculation or what they conclude with, because that will give us an indication of how exposed we are to exactly what you're talking about, stranded assets. I mean, when I used to be an oil analyst, and I still believe that we will be challenged in the future in Norway because there will be a declining demand for oil. And of course, it's a risk, especially after 2025, that we invest too heavily in new production. So I think it will be very interesting to see what this advisory board will say.
Thank you very much. So I think there is broad agreement. We want to make the world a better place. We want to move to a greener future. But we are all also concerned about causing damage to our economy, to our lifestyles, and so on in the process. We want to retain much of what we have. Many dilemmas, many lessons, and great expertise. So thank you very much to our panel and to our experts and to the audience.